we look at interest rates, I mean, the trend has just been higher highs, higher lows, generally speaking. The 1 year is just grinding sideways, not really higher highs, but definitely higher lows overall. I don't think the 1 year is going to move until something big happens, like the CPI moves, or actually more directly until the actual other yields move, but they will definitely move on CPI. So if CPI is very strong, if there's very strong inflation, then the interest rates should go up. These should spike up. I think we'll have big moves and some of them very significant moves. So 1 year will just start to close, I reckon, above 5.45, probably start to close above 5.5 for the first time ever. That could be very, very big. And then we just start to have more follow through. But as you can see, the trend is just, up. The 2 year, this is where it gets more serious. So 2 years where I've always said that the 2 years sets the rate for the Fed. And for me, it's higher highs, higher lows, overall up. And the 2 year, if the CPI is stronger than expected, I think we're going to close above 5.1, which is just massive. It's unprecedented. And that should just signal a blow off top coming, because I think that yields will go higher. But as soon as they start to go higher, I reckon the markets are going to freak out. People are going to buy bonds as the markets crash, and maybe even the Fed steps in. I'm not going to say they cut rates. They're not going to cut rates, but they might start saying, "Okay, we're thinking of being done now." So I think we will break out, but that's when the reversal. So I think there will be a quadruple top breakout followed by a reversal, but not straight away. But I think today could be the day. If CPI comes out stronger than expected, if it's weaker than expected, then they'll come down, but I don't know how much they'll come down by. So, if inflation is not that strong, not that high, then yeah, rates could come down. But let's see if we can take out this, if we can close below the ascending. But really, the key is closing below the last low down here, the last retracement. So 4.75. Do we get close there, or maybe not yet? And then it takes 1 or 2 days extra. The absolute key is this horizontal for me. I think once you close below that, then you're moving significantly lower, and then any move up should be sold. So, but again, I still think we're going to go up. So for me, it's really these, close below this level and ultimately this level. That's what you want to see to become medium-term bearish, let's say, or even short-term bearish. Because every time we have a big drop, they do seem to go back up again. 5 year, exact same thing. I'm not going to bother going through all of the equivalents. I think we're going to close above 4.5, huge number, and then we move up, onwards to 5%. I don't think we'll get there, but I think that's what the yields will start doing. Otherwise, a big move down. Can we close below ascending support? That's the first test for the bears. If we can we close below this level here, 4.15? And if we can we close below, 4%, let's say at least, or 3.9%. But for that, I can't see that happening. For me, that has to be a market crash, people buying bonds and freaking out. And that will only happen if yields start to squeeze up and send the market lower. So I still feel like yields will go higher. 10 year, same thing, a move up. We're going to start closing above 4.35%. And then, we may even close above 4.4%. It'll be such an obvious move. Like, you close above 4.35%, it's going higher. So they'll probably keep buying. So you may even close above 4.4% on higher than expected inflation. If we move down, the real test is closing below 4%, I would say. I mean, this is too easy. This is so close. It's a psychological number. Close below 4%, you can start moving down to 3.7%. And 30, very similar, we'll probably get a close above 4.5%. That's what you're looking for. Otherwise, a close below this level here, 4.2, 4.1. Ultimately 4%, let's see. But you've got quite a bit of support on the way down. That's the thing. You got one level. Okay, this is one general level, these two. Then you got the 4.1%, and then 4, which is a big number, and ascending. So even if we have a big move down, you have a lot of support on the way. The only thing that can send a massive move down would be, if there's a market crash. No one cares about levels to some extent. You have to recreate your levels. That's what we have to do over here. So yields for me are strong, higher highs, higher lows, going higher. If CPI is bad insofar as there are, higher than expected inflation. If it's the opposite and inflation is lower and they fudge some numbers or whatever, then down it goes, but there's a lot of support. And there's CPI data coming out very often, so you can't just go all the way down. One number doesn't change a trend. The trend is still up, and I think inflation is making a comeback. So I'm definitely on the bias to the upside on yields. Let's look at the dollar. Dollar, despite this move down, because the BOJ is still not bearish, because look, it's just retesting prior resistance, and it held. Look at that. The next day it held very well. Yesterday, Tuesday, so far today we're moving back up. If inflation is higher than expected, although that should be bad for the dollar fundamentally, we know the market doesn't really trade logically at the moment. Yields up means the dollar up. That should be the case today also. So if CPI comes in bad with hot inflation, hotter than expected, the dollar may go back up and close above 105, and then we're looking at this 106 range. And this was just a little retracement. This BOJ stuff was a retracement. But, let's see. The dollar is something a bit more specific. I do think that we'll go up, because I think inflation numbers will be bad. I think we will close above 105. I think we will start moving to 106. And this trend is intact, ascending steeply, by the way. Normally these are easy to break and flush, but so far it broke it when it was this steep one here, if you remember, but that was way too steep, and that the correction was coming. But the corrections are very short. Remember this? Look at that, very weak. Move down, it just went all the way back up. So dollar is still intact on the way up, and it's all about CPI. So I think a close above 105 will happen. And if inflation is weaker than expected, then we're looking for a move below 104, close below 104. That will probably send us all the way back down to 103, because then this steep move is broken. Plus, there should be some follow through. It's not just a one-day event, but then we'll have a bounce at 103, and then we'll see what happens. If we do move higher, though, in the DXY, after the inflation saga is over, after the CPI related follow through is over, so we go 105, a little sideways move back up to 106. Remember, you got this Japanese yen, which around 150 is a serious problem. Like, this will move back up. Today this will move back up and close above 148 if inflation is hot, and then we start to move up to 150, and this is danger zone for the Japanese yen. So, although I think the DXY get to 106 and against the Japanese yen 150, I do think something will happen here. Maybe the Fed, maybe the Japanese bank. But I think there'll be a strong move down. So that's just my suspicion. But watch out, DXY could still keep moving up. Okay, so that covers the dollar and interest rates.